Alright, let's take a quick tour of some common ways to invest your money, beyond just savings accounts. Investing is crucial for building wealth and securing your financial future. By exploring different investment paths, you can potentially achieve higher returns and diversify your portfolio. Think of it like exploring different paths to grow your wealth. Investing is all about putting your money to work to potentially earn more money. There are various types of investments such as stocks, bonds, real estate, and mutual funds. Each comes with its own level of risk and return. It's crucial to have a diversified portfolio to balance these risks and maximize potential returns. Real estate. This means buying property, like houses, apartments, or land, with the goal of it increasing in value or generating rental income. There are different types of real estate investments, including residential, commercial, and industrial properties. The process involves finding a suitable property, securing financing, and managing the property, which can include maintenance and dealing with tenants. While real estate can offer significant rewards, such as appreciation in property value and rental income, it also comes with risks like market fluctuations, property damage, and the challenges of property management. Bonds. These are like loans you make to a government or company. They pay you interest over time and return your initial investment later. There are different types of bonds, such as government bonds, corporate bonds, and municipal bonds. Government bonds are issued by national governments, while corporate bonds are issued by companies. Municipal bonds are issued by local governments. Bond prices are influenced by interest rates, credit ratings, and market demand. While bonds can offer steady income and lower risk compared to stocks, they are not without risks. Interest rate changes, inflation, and credit risk can affect bond prices and returns. Understanding these factors can help you make informed investment decisions. Additionally, bonds can be categorized based on their maturity periods. Short-term bonds typically mature in less than 3 years, medium-term bonds in 3 to 10 years, and long-term bonds in more than 10 years. Investors should also be aware of callable bonds, which can be redeemed by the issuer before their maturity date. This feature can impact the bond's yield and overall return. Diversifying your bond investments across different types and maturities can help manage risk and optimize returns. Mutual funds. These are baskets of investments, like stocks or bonds, managed by professionals. There are different types, such as equity, bond, and index funds. They are managed by fund managers who make decisions on buying and selling assets. Fees can include management fees and expense ratios. While they offer diversification and professional management, they also come with risks and potential rewards. You're buying a small piece of many different things. Stocks are generally riskier investments but have the potential for higher returns. Historically, stocks have outperformed bonds over the long term. However, stock prices are influenced by various factors such as company performance, economic conditions, and market sentiment. Bonds, on the other hand, are typically safer but offer lower returns. Their prices are affected by interest rates, inflation, and credit ratings. Think of stocks as potentially winning big, with higher risks and rewards, and bonds as a steadier, slower growth, providing more stability and lower risk. Real estate often requires a larger initial investment compared to stocks. This means you might need a significant amount of capital up front to purchase property, which can be a barrier for some investors. It's also less liquid, meaning it's harder to sell quickly. If you need to access your money fast, real estate might not be the best option. Stocks, on the other hand, can be bought and sold much more easily. With just a few clicks, you can trade stocks online, making it a more flexible investment. Real estate can provide a steady income via rentals, while stocks can provide dividends. Rental income can be a reliable source of cash flow, and dividends can offer regular payouts from your stock investments. Both can grow in value over time. Real estate values can increase as the property market grows, and stocks can appreciate as companies expand and perform well. Historically, real estate has shown steady appreciation, often outpacing inflation. This makes it a good hedge against rising prices. Factors like interest rates, economic conditions, and location significantly impact real estate prices. A good location can dramatically increase property value. Stock prices are influenced by company performance, market sentiment, and global events. News and events can cause stock prices to fluctuate rapidly. Both investments come with risks. Real estate can be affected by market downturns and property damage, while stocks can be volatile and subject to market crashes. Diversification can help mitigate some of these risks. However, Both offer potential rewards, including capital appreciation and income generation. Whether you choose real estate or stocks, understanding the pros and cons can help you make a more informed investment decision. Mutual funds are more diversified than buying individual stocks. This means that when you invest in a mutual fund, your money is spread across a wide range of assets, including stocks, bonds, and other securities. This reduces risk because your money is spread across many investments. If one investment performs poorly, others in the fund can help balance it out, providing a more stable return over time. Historically, mutual funds have shown steady growth over time, benefiting from the collective performance of various assets. This makes them a popular choice for long-term investors looking for consistent returns. Individual stocks can potentially provide higher returns if you pick the right ones. Successful stock picking requires research, timing, and sometimes a bit of luck. However, they also carry greater risk. The value of individual stocks can fluctuate widely, sometimes dramatically, based on market conditions and company performance. Factors such as company performance, economic conditions, and market sentiment can significantly impact stock prices. This makes investing in individual stocks more unpredictable and potentially more stressful. Mutual funds are generally less hands-on than picking individual stocks. They are managed by professional fund managers who make investment decisions on behalf of the investors. While mutual funds offer a balanced approach with moderate risk and reward, individual stocks can be more volatile, but potentially more rewarding. Choosing between them depends on your risk tolerance, investment goals, and how much time you want to spend managing your investments. Bonds are generally considered less volatile than mutual funds that contain stocks. Historically, bonds have provided steady returns with lower risk. Mutual funds, especially those with stocks, have shown higher volatility but also higher potential rewards. Bond prices are influenced by interest rates and economic conditions. Mutual fund prices are affected by the performance of their underlying assets. Bond mutual funds are a way to diversify your bond holdings and can be less risky than a stock-based mutual fund. Both investment paths have their own risks and rewards, and understanding these can help you make informed decisions. Real estate is like buying a house to rent out or sell later. Bonds are like lending money to a company or government and getting paid back with interest. Mutual funds are like buying a pre-made basket of different investments. Stocks are like owning a small piece of a company and sharing in its profits. Gold is like holding a timeless treasure that can be sold when its value increases. Cryptocurrencies are like digital money that can be traded online, with values that can change rapidly. Diversifying your investments means spreading your money across different asset classes like stocks, bonds, real estate, mutual funds, gold, and cryptocurrencies. This strategy can help reduce risk and increase potential returns. Gap-0.5S. When you diversify, you're not putting all your eggs in one basket. If one investment performs poorly, others may perform well, balancing out your overall returns. For example, if the stock market is down, your bonds or real estate investments might still be doing well, helping to cushion the blow. Gap-0.5S. Diversification also allows you to take advantage of different market conditions. Some assets perform better during economic booms while others are more stable during recessions. By having a mix, you can navigate various market cycles more smoothly. Gap-0.5S. Additionally, diversifying can help you achieve a more stable and predictable income stream. Different investments yield returns in different ways. Some provide regular income like rent from real estate or interest from bonds, while others may offer growth potential, like stocks and cryptocurrencies. Gap-0.5S. In summary, diversification is a powerful tool that can help manage risk, smooth out returns, and provide opportunities across various market environments. It's a fundamental principle for building a resilient investment portfolio. Investing always comes with risks, and understanding these risks is crucial for making informed decisions. Let's go over some common investment types and their associated risks. Starting with stocks, the main risk is market volatility. Stock prices can fluctuate widely due to economic changes, company performance, or market sentiment. To mitigate this risk, consider investing in a diversified portfolio of stocks across different sectors and industries. Next, bonds are generally considered safer than stocks, but they are not without risks. Interest rate risk is a primary concern. When interest rates rise, bond prices typically fall. To manage this, you can invest in bonds with different maturities or consider bond funds which diversify across various bonds. Real estate investments carry risks such as property value depreciation, vacancy rates, and unexpected maintenance costs. To mitigate these, conduct thorough research before purchasing property, diversify across different types of real estate, and set aside a reserve fund for unforeseen expenses. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. While this diversification can reduce risk, mutual funds can still be affected by market fluctuations. Understanding the fund's investment strategy and reviewing its historical performance can help you choose a suitable mutual fund. Cryptocurrencies are highly volatile and can experience dramatic price swings. The regulatory environment for cryptocurrencies is also uncertain. To mitigate these risks, only invest money you can afford to lose, and consider diversifying into more stable investment options. Gold and other commodities can act as a hedge against inflation, but are also subject to price volatility due to supply and demand changes. To manage this risk, limit the proportion of your portfolio allocated to commodities. In summary, every investment comes with its own set of risks. By understanding these risks and employing strategies like diversification, thorough research, and consulting with financial advisors, you can better navigate the investment landscape and work towards achieving your financial goals. Each investment has its own risks and rewards. It's crucial to understand them before investing. Diversification is key to managing risk, and it is always a good idea to speak with a financial advisor. Doing your own research is essential to make informed decisions. Educate yourself through seminars, books, and online resources. Professional financial advice can provide personalized strategies tailored to your goals. Combining your own research with expert advice can lead to better investment outcomes.